Hi, everybody. This is Robert Chadwick with American Mortgages. Thank you for joining us for our newest webinar. We have with us today is one of our fantastic partners, Thomas Carden. Hey, Thomas. And what we will be discussing today, besides the standard, how do you qualify for a U.S. mortgage when you're living outside of the U.S., but we'll also be talking about what everybody is curious about, how to mitigate and save on U.S. taxes with a proper focused accountant that deals only with the U.S. tax scheme. So with that said, I will hand this back over to Thomas with American International Tax Advisors. After Thomas speaks, I will go over some of the information on qualifying for a mortgage as a foreign national or as a U.S. expat. And then at the very end, we'll have a very interactive question and answer, which everybody can participate if you see the question button on your Zoom. We won't be answering any questions until the end, but we should be able to get through everything by the time we finish. So Thomas, with that, thank you for joining us. Perhaps you can give us some information about your company, and then we can kind of go into the slides.
All right. Again, my name is Thomas Carden. I'm an IRS enrolled agent out of American International Tax Advisors in Bangkok, Thailand. We're one of Asia's largest U.S.-centric tax firm, and we deal a lot with U.S. expats who live overseas, companies that want to do business with the United States, and investors in U.S. real estate back in the United States as well. Rental real estate has been one of the, for the U.S., has been one of the greatest wealth builders of the last 100 years to that. And it's open for both Americans and people overseas. It's an open market, so anybody's able to go purchase property there and allow that to grow and build wealth over the generations. To give you guys a little more background, I've got a master's degree in international tax and financial service law from Thomas Jefferson School of Law out of San Diego. To this, I've been practicing in the U.S. tax area for just about 25 years now with this, and so we've got a broad base of experience in this. But real estate has always been a primary driver of the U.S. economy, and one that can make a lot of wealth. Let's go ahead and do that. Today we're going to go through the four basic things: U.S. taxation of rental income, taking advantage of deductible expenses, depreciation, which is a big part of number two. In fact, it's so large that it's its own thing. And then again, we'll go a little bit through who we are with this. We're primarily going to do this. There's a little bit of a quirk for non-U.S. residents to this, in that when you've got U.S. sourced income to this, such as rents, and you're not a U.S. citizen, you're going to be subject to a 30% withholding tax on the gross amount of each rental payment. And the key to that word is gross amount of each rental payment, because we can do the net to it. That's the foreign owner earning rental income can easily have the 30% withholding obligation removed. The foreign owner must only pay tax on the net rental income on the U.S. tax return. This is why deductible expenses become so important with this. One of the biggest deductible expenses in this, you can go ahead and go to the next slide on this, is going to be mortgage costs. So you've got, in the basic ones, you have property management fees, advertising and marketing, leasing commissions, repairs and maintenance, utilities, property taxes, and insurance. And the bigger one that needs to be added to this, do we have a second slide? I think we have a second slide of expenses. Here you go. Mortgage interest, legal and professional fees, licensing and permits, homeowners association dues, capital improvements, depreciation, and we'll go through that again, travel to inspect the property, and pass through tax deduction. Okay, everything here is pretty straightforward, but we're going to go through two big ones here, and why you want to have a mortgage on a rental property in the United States. Rental property has a big advantage in that you can be cash flow positive, but tax flow negative. Okay, this is a huge key to this. Okay, now let's say you go and buy $100,000 rental property and you get $8,000 of interest per year with this property. Now, that's an 8% yield. But if you can go in and buy at 4%, get a mortgage on a property instead, so you could have if you were able to get a 0 cash down mortgage, you'd be making 4% plus the mortgage interest. Now, one of the keys to that is that mortgage interest is 100% deductible on an annual basis. So every time you make a mortgage payment, it comes off as a expense off of that gross income and that 30% tax. Now, it gets more powerful when you take that $100,000 and you buy a $500,000 piece of property with a 20% down rate to this. Now you're getting a yield of that 8%, instead of $8,000 is $40,000. And $20,000 comes off as a mortgage deduction to it. And you've got 20,000 of non-taxable of income taxable at that 30% rate. But again, there's another benefit of this. As long as this is a U.S. property, and this is where we come into depreciation, you can deduct the expenses in the property off over a 27.5-year period to this, which means the price of the house, not the land, is deductible over 27.5 years. So at $400,000 of a house price and $100,000 of land on that property, you're going to end up with a depreciation cycle of just about 4%. So between depreciation and mortgage interest, you have a rough income, you have a positive cash flow, but almost no income for U.S. tax purposes to this, especially when you throw in property taxes and everything else, which can be a small percentage on this. What this means again is you can move completely away from that 30% tax bracket, still have that income coming to you above the mortgage interest, and that income is 0% tax. So let's put it again this way. When the original thing of you buy $100,000 house and you have $8,000 of rental income per year, you're going to owe 30% tax on it. If you roughly with this, although a little bit of depreciation will kick in of a couple $1,000s a year. So you got about $6,000 property of taxable income to this. If you go into, you're going to lose about $2,000, right? So if you go into the $500,000 house with the $100,000 mortgage on this, you go into a situation of where you got $40,000 of income, $20,000 of mortgage interest as a deductible expense, and then $20,000 gets written off mostly as a depreciation expense, but you've got a net positive cash flow of $20,000 per year. Now, this is a grand thing, and you've got a pretty good net income yield on a $100,000 investment, which can be roughly 20% to this. Now, I'm using all back of napkin math on this. Obviously, this stuff gets adjusted and tweaked down to it. But your income yield goes way up, and guess what? Your tax bill goes way down to almost zero using the depreciation and the interest property on this to this. So this is one of the weirdest things in the world, in that you want to use leverage on a rental property very, very heavily, because it allows you to get more cash flow in your pocket each year. Now, a lot of people, there's one back end for rental property that's on U.S. It's the bad side of this. And that's when you go to sell, you have to recapture that depreciation expense, even if you did not use it as an expense on your tax return with it. So that means you get kicked in the teeth a bit on the backside of this, but you really never have to, because you can do one of two things again. So in about 5 to 8 years, the property, a $500,000 property, should have increased by about $100,000, your initial investment. What you would do at that point is you go back to Robert and you say, I want to refinance my property and take all of the cash out that I can off that rental property. So you literally take out your initial investment, and then you let the investment continue to grow, because rents will increase year by year by year, and you continue doing the same thing. So you pull your cash out above the amount of cash flow you have, because you can pull your principal out at a later date and still own your property, folks, to this. You're never going to find a bond out there anywhere that you can pull the principal of the bond out 5 to 6 years later and still own the bond that's producing the interest with. You can only do that with rental property in the United States because of the capital appreciation of the rental property. Now, and at some point though, in the life of the rental property too, you may say, you know, I'm tired of this particular rental property. I want to go buy something, another rental property or like kind property to that. Here's the good news too. The U.S. has what's called a like kind exchange. As long as you do certain rules, you can switch that rental property in, you can sell that rental property and buy another rental property. You can also take that capital out as a loan to yourself and then buy, guess what? More rental property if you want to continue on being a landlord in the United States. This is why this has been a very, very powerful wealth building tool in the United States. And if you use the basic techniques, these are very proven formulas that allow you to build wealth over a period of time, you know, to this. Now, in the next slide, we'll give you a little bit of communication information from me directly to this. Now, you can always contact Robert at American Mortgage if you have any specific questions to this, but you can also call us. We're here in Bangkok, and we've got a U.S. phone number and our website, and you can email Chris at any particular time with this. But you really have a lot of advantages to this as far as owning rental property in the United States with this, and that ability to pull cash out, by refinancing and just own these investments forever is a really powerful wealth building tools. A lot of people end up where they get so cash flow positive that they just go in and use the cash from the income of both the new rental property and the existing one and the equity to just keep adding extra rental properties to their portfolio. There's a lot of people who have 40 or 50 rental properties they built up over the decades in the U.S. because the tax situation is so favorable to you. And this has always been a way of in the U.S. of incentivizing small landlords to be able to own property and to build them, and to make profits off of them, because the vast majority of rental units in the United States are still owned by individuals. They're not owned by great big trusts or corporations to this. Although that's been changing recently because some of the big equity funds have gone in and started buying rental properties in the U.S., which is a sign that says this is a very good way to go ahead and build your wealth to it if these big funds are moving into it. That's how advantageous this is, with this. And again, if you have any questions, we give for American Mortgages clients, we give a free half-hour consultation. You can ask any questions in that, and I'm happy to answer them for it. So all you have to do is either contact Robert or contact Chris at aitaxadvisors.com, and we'll be glad to help you out and help you move forward. Robert, you want to move forward, or do you have any points that I think I missed?
Yeah, super good information. I think, and this is, I think, a general consensus. A lot of people have a very big misconception of what U.S. taxes are in the U.S. and will they be subject to global taxation, et cetera. And things such as cooling measures or stamp duties and so forth. So maybe you can kind of just touch on that a little bit on there's no cooling measures in the U.S. There's no global taxation.
This is one of the the biggest strengths in the U.S. is an open market in general. Okay, you will be treated as for a sale of a property exactly as if you are in the U.S. You can move these funds out of the U.S. There will be anti-money laundering restrictions. You have to ask the bank with this because they don't want, criminal moving money around. But as long as the bank sees this as the source of the funds, is the rental property or sale of rental property, you can wire that money, anywhere in the world you want it to go, that allows the wire system. Cuba is one of the few countries that doesn't work for that with it. But you are treated equally to this. There's no stamp duties. There are property taxes that maintain the street lights in the cities and the sewer systems to this. But again, those are all deductible. But it's a huge open market that allows everyone access to this. So you're treated the same. The one issue of this is that 30% tax rate for non-U.S. residents, but it's possible again to with proper planning to never have to deal with that tax issue whatsoever. you can get very, very positive cash flow and be tax negative in the United States on rental property. And this is really the only type of investment that does that. And that was set up a long time ago to literally incentivize people to go in and help build out houses, to build out the housing supply in the United States. And right now, the housing supply in the United States is short by 500,000 to 600,000 units to this. They need more rental units there. So the incentives are still there for landlords in most states to go in and build out the rental properties, to this. And so you can get these mortgages on rental properties and do very, very well with them, to this. And one of the things, there may be a fair amount of people in here who are looking for Robert on the backside of this who already own properties in the U.S., even if you're a U.S. citizen. And my banking issues are one of my biggest pains of all. American Mortgages is able to go in for U.S. citizens and do this. This isn't just for non-resident aliens too. Go in and help you get a mortgage on a property in the United States. And a lot of people move out of the U.S. and they have an empty house in the U.S. Get a mortgage on it, and you can buy a property over here, put it in a rental thing for your income, and allow yourself to use that property and get extra income off of it. And that's the real key to this. This works for American citizens just as much as it works for non-resident aliens. And that's part of the open market in the United States. Everybody has access to the same set of rules to it, by far,
Yeah.
with it.
Yeah, thank you, Thomas. Again, I think it reflects on, again, the misconception of U.S. taxes, especially when it comes to owning rental property. So
Yeah.
with that said, thank you. I will go into the mortgage portion of the presentation, and then at the end, we will bring Thomas back on, and we'll have a question and answer session. So again, thank you everybody for joining us. If this is the first webinar that you've joined, we have these pretty much every other week. And we try to bring in on a regular basis a specialist in one matter or another that is very relevant to what our clients' needs. So I will go over the mortgage programs that we have for foreign nationals and expats. The basic general overview for all of our loans, there's no U.S. credit required. I know this is a big issue. It's a big question that comes up a lot. A lot of people, just like the misconception of U.S. taxes, they think that they have to have U.S. credit in order to obtain a U.S. mortgage. That is absolutely not true. We can take credit from your home country in lieu of your U.S. credit. All of our lending is no AUM required. It's all dry lending. Meaning that you are not required to set up a bank account in the bank that's providing the mortgage loan. And like most, or probably one of the most popular banks that also does U.S. mortgages, you're not required to hold those funds or even open an account for the term of the loan. We allow all foreign income, whether you're a foreign national or you're a U.S. expat. I think what makes us quite unique is we have loan programs in all 50 states. If you're a foreign national, you can get up to 75% financing in all 50 states. If you're a U.S. expat and you still maintain U.S. credit, you can get up to 80% financing. Normally, once you submit all of the documents required, and I think you'll find it to be quite simplified, we can normally issue you a loan approval within 72 hours. So if you're looking to purchase a property and you require a pre-approval letter, so when you submit your offer, you'll have this letter saying you've already gone through the mortgage process and you've been approved for a loan. It makes it actually quite smooth when you put your offer in. We have closing times on average are 30 to 45 days. It really depends on how you choose to close, but a normal purchase contract is somewhere between 30 to 45 days, and we're quite good at making the closing time. You can sign your closing documents in most, excuse me, in most major countries. So there are a variety of ways of doing it besides going to the U.S. Embassy. There's at least 5 different ways. So when we get your application, you get an accepted offer, or if it's in a refi, we determine right from the beginning what is the best way for you to sign your closing documents, and we put that in play from the very beginning, so you have a timeline. We do both purchases, refinances, and equity release. And I think one thing that you're going to find if you're not familiar with the U.S. mortgage market, you can take advantage of long duration mortgages. So say 30-year mortgages. We even have some that are 40-year mortgages, regardless of your age. Now, this is very unique to the U.S. So whether you're 19 or 99, you can still take advantage of a 30-year mortgage. You cannot discriminate in the U.S. against anything, and age is one of them, which allows this benefit. We have loan programs where it is interest servicing only. And what makes this program really fantastic, especially now where rates are a little bit higher, but still historically decent, it allows you to fix an interest-only rate for 10 years. After that 10-year period, that loan converts into a 30-year fixed without any adjustment in rate, but now you're paying principal and interest. So you have a total 40-year tenure. It really is a great way to come in when maybe rates are a little bit higher, and hopefully during this 10-year period, rates come down, you could refinance into a principal and interest mortgage, or even maybe into a cheaper, another 10-year interest-only loan. We have loan programs that make sense. Common sense underwriting. We treat a lot of these loans as we do treat a commercial loan. So if you were going to buy a building or commercial property, it normally goes off of cash flow. So we have loan programs for foreign nationals and expats that qualify the same as a commercial mortgage, meaning that if the rent qualifies for the mortgage payment, then the property qualifies. And I'll go into that a little bit more in another slide. One thing that we're quite proud of is 97% of the loan applications that we submit get approved with the lenders. And why is that? Is because we are by far the industry expert when it comes to foreign nationals and expats. 100% of our clients are living and working abroad. You will absolutely not have the problems that you do have when you go to a local bank or even a local broker that maybe sees one person living overseas out of maybe 100 transactions. With us, every single client fits this mold, and it makes it a very smooth, easy process. We have loan officers in 12 different countries. We have processing, we have assistance, etc., which allows a 24/7 access, meaning that you don't have to stay up late at night talking to a bank in New York or whatever it may be, depending on what hours you are. You will be working with a loan officer in your time zone that even speaks your language. So our loan programs, they are quite unique. They are depending on how you qualify. We have this is probably one of our most popular loan programs. This is called the American Mortgage Express Plus. What this is, and this is what I was talking about with the commercial mortgage before, is there's no personal income taxes required for this loan. This loan is going to be treated as a true commercial loan, and you're going to qualify based only on the rental income of the property, meaning that you do not have to provide your tax returns or pay statements or NOAs or whatever it may be. When we get the appraisal or the valuation on the property, we will request a supplement. That supplement will tell us what just like the average property purchase price or value, It'll also give us an average of what the rental income would be for this property, and we use that as your income to qualify. Again, no U.S. credit is required. This loan program can go as low as $150,000 up to 75% loan to value and a normal closing time of 30 to 45 days. The AM Investor Plus is a very similar loan program. It does have a little bit better rates, but a little bit more requirements. Again, there's no tax returns required because we are doing loans for borrowers all over the world. If we had to go through various tax returns, it wouldn't be feasible. So how we do it, in order to show your income, instead of providing local tax returns, you're going to provide a letter from your employer if you're employed, or your accountant if you're self-employed, and we have a template for this. And that letter is going to state 2 years of income and current year-to-date income. And that is all that we're going to ask for. You still have to provide 2 months of bank statements, et cetera. But when it comes to providing complicated tax returns, et cetera, not necessary. So going over what the AM Investor Plus loan looks like, because a lot of people have questions on how do you qualify only on the cash flow of the property. And it's very, very straightforward. So if you were to take, for example, you're buying a property here and you have a gross rental income of $2,400 a month. As long as your mortgage payment, and when I say mortgage payment, it includes the principal, the tax, the insurance, maybe if there's an HOA, whatever is the total gross mortgage payment, as long as that is equal to or below what the gross rental income is, the loan qualifies. It's a really great program, and it's really how these rental properties should be looked at. And I think we're one of the few people that actually view it this way. So that is the gist of the loan programs that we have. If you'd like to contact us, or you'd like to get some more information on the types of loans that we offer, besides the ones that we reviewed today, please reach out to us. This is our contact, so you can scan it, and we will we'll be able to assign a loan officer to your case. You could speak to them. It's free of charge. Getting a loan approval is free of charge. There's no application fee, et cetera. So thank you, everybody, for your time. I appreciate it. We will start a question and answer session now. Okay, so wow, looks like we already have quite a few questions. Let me get to these here. So I'll read the questions, Thomas, and then
Okay.
we can decide who's going to answer it and go from there. So first question is, can international investors use a 1031 exchange to reduce taxes?
That was what I mentioned earlier, the like-kind exchange. I try not to get a little too tax wonk in conversations on stuff, but that's exactly what you can do. You can avoid that tax by moving from one property into another with a 1031 exchange or a like-kind exchange. As long as you're moving from rental property to rental property, that's okay. Now that rental property can move from a single family house to an apartment building if you want to with this. That allows you to do that with this. Now, the advantage of a 1031 exchange is twofold. No capital gains tax upon the appreciation of the property, and no tax on the recapture of depreciation. Now, what a lot of people don't realize too, though, is with a like-kind exchange, it's possible to do a little bit of both in this. You can take, you could do a like-kind exchange on, say you have a property that's been built up to $1 million. You could do a like-kind exchange and take $200,000 out and pay tax on that $200,000 and exchange the other $800,000 into another property with it. There's a certain level of complexity, and before you do it, you need to talk to a tax advisor, and the closing attorneys have to be very specifically, because the new property has to be identified within about 90 days, and a very special set of circumstances has to be done. The money has to go into an escrow account But yes, those same rules are open for both U.S. citizens and non-resident aliens. And a non-resident alien in U.S. terms is anybody who's not a U.S. citizen or green card holder. If, again, I try not to be too tax wonk on the speak, but if I use that term, that means if you're not a U.S. citizen or green card holder, you're a non-resident alien for investment purposes in the U.S.
Yeah, thank you, Thomas. And I think with our parent company, Global Mortgage Group, we do loans all over the
Yeah.
world. And this 1031 exchange, unless there's a country I'm not familiar with, this is one of the few US has, besides the fact that there's no stamp duties, et cetera.
Yeah.
But this 1031 exchange is such a fantastic tool, especially as you're trying to grow your real estate portfolio.
A lot of people get to the point where they have so much equity that they want to go in and buy something bigger with it. But at the same time, so say you do want to move from one or two individual properties into an entire apartment building. This process allows you to do that. And again, all of this is because the entire U.S. tax code, especially for rental property, is meant to it realizes and takes into effect and is trying to help you increase the housing supply in the United States. So the code is very, very friendly because they want you to go in and build this to allow more people to be able to have housing stock to rent with this. And that's, so it's a positive code in this. And there's not a lot of investments that are as good tax wise as this, other than potentially farm income, which I'm assuming American Mortgage could do a farm mortgage if they wanted to as well.
Probably not, but
Yeah.
okay.
You can count a residence as a farm at times and still get the income if it's got enough acreage. So it is possible to do that on our home loan.
Okay. So next question is, can we write off the interest, taxes, and property management fees on a rental investment?
Absolutely. That list I went through earlier, it's going to be anything that's valid for this. And one of the things about this is that trip that you want to take to see your rental property and discuss with the manager once a year or every 2 or 3 years is a tax deductible expense off the rental to this. So if it starts getting there, guess what, folks, you can get a round trip for yourself to the United States, and it's a deduction off of that rental property. Very, very few rental properties, especially if there's a mortgage on it, pay any tax during the year to this. There's a vast number of things that are out there, including repairs and homeowners association fees. All of those things are deductible to it, with it. So, anything that's a sensible business deduction and that really is set to this is there, including, 99% of you guys out there, if you're buying a rental property in the United States and you're not in the US, are going to have a manager. That management fee is very, very specifically a deductible expense, to it. Yes.
Next question, I can answer this, and I sort of touched on this earlier.
Yeah.
Do I have to pay stamp duty when I purchase a home in the US? Absolutely not. The US does not have stamp duties. Everybody, regardless if you're a US citizen or a foreign national, if there are certain specific taxes, for example, in New York, it has a luxury tax or a mansion tax, I believe it's called, and in certain counties, higher mortgage registration taxes. But whether you're a US citizen or a foreign national, everybody pays it. But if you were to look at the US in general, there are no stamp duties. There are no cooling measures put into place. It is truly a free and open market. So as the properties appreciate or depreciate, you take advantage of it.
Yeah.
Next question. As a foreigner, how long does the pre-approval process usually take? I'll answer that as well. It depends on how you qualify with the loan programs. As you saw from the slides, our loan programs are very straightforward, quite simple to qualify for. Once you submit the application and the required documents, we can normally get you a loan approval within 72 hours, often much quicker. If you need it immediately because you found a property that you have to have a pre-approval letter for you, we've done it, in as quickly as the same day. So it really just depends on the time that we receive it and how much information we have from you as a borrower. Next question. Hi there. Query: who appoints the appraiser, me or the purchase or the debt provider? Excellent question. So if we were to go back to before the financial crisis, appraisals were appointed basically by anybody. Now appraisals are all required to go through something called an appraisal management company. And it's almost like a random selection of appraisers. The broker or the bank has very little contact except for, just updates and status of when the appraisal is coming in, but there's very little transaction or conversations between the appraisal management company and the broker for the specific purpose to make sure that the value of that property is accurate. So to answer your question, the appraiser will be appointed by the lender of the property, or will be the lender of the property. Next questions. Are there any restrictions or additional considerations when purchasing a property through a foreign LLC? So let me touch on this a little bit, Thomas, and then maybe you can go into the advantages of an LLC. So we don't allow a foreign blocker. So if you're looking for a foreign entity to hold a U.S. LLC, unfortunately, that's not allowed. But as a foreign national or even as a U.S. expat, you can hold title of your U.S. property in a U.S. LLC or corporation or however it would be, individually as well. But there's a variety of reasons why you would do this. And maybe Thomas, you can kind of expand on that.
Yeah, actually the largest would be the estate tax issue in the United States with this, because as a foreign national, you really only have about $160,000 of equity that can be passed to you. However, the shares in the LLC don't count toward to that. So a lot of foreign nationals have set up a U.S. LLC, Nevada or Delaware. To this, I tend to be a little bit of a Nevada fan. And you can set that up, and you essentially, to your heirs, you would pass shares of the LLC rather than the house itself. It's a little cleaner just for estate tax purposes to it. Slightly more, $100 more compliance cost a year, but the issue of passing these things on, and again, you kind of want to own these things for a long period of time. So it's becoming more and more popular for foreign nationals to own in a U.S. based LLC to this, and only because of the transfer of that. And you can also transfer that LLC. You don't have to sell the property to it. You can sell shares of the LLC as well. It's one way to get around transferring some of this stuff, because the LLC continues on as its own entity, as well. So you can do that way as well.
Great, thank you. Next question. For income tax purposes for rental property, is the total rent considered income, or is the total rent minus the mortgage payment? Thomas, that's you.
Yeah, this is the gross versus net to it. Okay. The U.S. for tax purposes, the U.S. always uses net income. So so say you had a property that was over 27 and a half years and you just only had a mortgage on that property. So yes, the net rent would be the gross rent minus the mortgage interest to this, and you're going to throw in property taxes, because each property will have generally city, county, and state and property taxes that have to be paid to this, with it. So all of that is an expense off into the net with it. And it's your net, even counting depreciation, which is not a cash flow, comes out of your pocket, is your net for tax purposes.
Thank you, Thomas. Next question is, for me, what are the interest rates that are available over 30 years for an interest-only mortgage? So excellent question again. It really varies on if you're a foreign national, if you're an expat, how you qualify, if you're qualifying only on the rental income of the property, or if you're qualifying using income. So on average, you're talking about rates around 8%. If you're looking at, interest servicing only. One of the things, and Thomas, you probably, again, kind add to this, but you can never time the market. We always say you marry the property and you date the rate. So you can get into a property with a good mortgage, with a decent payment, especially if you're using interest only. And then when rates go down, you refinance. The advantages now, as opposed to when rates were say 3 or 4%, people are not bidding over what in certain markets. As an example, even in Austin, Texas, which has always been sort of an affordable market, we had clients purchasing a $2 million property and they were getting outbid by 10-20%. That's just not happening now. So it's actually a really good market, even though the interest rates are a little bit higher. If you look at your overall expenditure, it actually makes more sense to buy it even at a higher interest rates because you're paying the proper value of the property. And I don't know if Thomas, you want to add to anything on that.
Yeah, I mean, and one of the keys to this is, investment values are always inverse to interest rates. So right now, the property market is soft, even though there's still demand for a huge number of units. And in places like Austin that are constantly growing, you're not paying an over amount on this. But going in later on and then refinancing the property and getting a much lower interest rates, because interest rates are bound to go down here over the next 24 to 36 months, will cause two things. The overall value of your property will increase and may increase dramatically as interest rates go down. And then, there's no tax consequence for remortgaging. You even may be at that point be able to pull equity out. And again, when I mentioned earlier, that you can go refinance in 6 or 7 years and pull your initial investment completely out of this thing. And you've had the income to this, and you still own the rental property, for the future to this. So you can use that refinance tool, because refinancing and taking a loan out of essentially more on your property is not a taxable event to this. The IRS goes, we're just saying you have $200,000 in your pocket now, that's a taxable event. No, that's not a taxable event. So that's how you effectively pull mortgage out of U.S. rental, or pull cash out of U.S. rental properties to this. And as I said, it's the only investment I can possibly think of on earth where you can pull your money out free of tax in about 6 to 8 years and have no tax consequence on that. And guess what? Still own the underlying investment to it. It's one of the quirks of the tax code and why people become very, very successful in these things. So it's a huge tax advantage to refinance now. You're getting a bit of a bargain right now. If you go buy the property, you're going to take a little bit of a hit in the teeth for a higher interest rate for 18 to 24 months. Go refinance, and then your payments go down and your cash flow goes way up to it.
Very good advice. Thank you, Thomas. Next question is, does your company have DSCR loans? Absolutely, we do, but we actually have what I like to say DSCR on steroids. So if you have any questions or you want to inquire about that, just reach out to us and we can kind of show you how this works, but how this works actually to a much better advantage through us. Okay, I think this is for you, Thomas. I'm not sure I completely understand the question, but perhaps you can. It says, can salary be deducted for tax purposes?
If you are a U.S. citizen, you're living overseas, you can use the foreign earned income exclusion on your salary to this. Now, that's on you as an individual. However, if you do have a building, so say you go buy an apartment building, and I know Robert is able to do very large apartment complexes too in these mortgages. So you have property managers and you are paying a salary for that property manager too there. Yes, that salary is a deduction off your rental real estate to this. So yes, if somebody comes in and buys a 24 or 36 unit apartment complex in Orlando, and they build a lot of those things out there, you can get a mortgage, and yes, the employee management fees there that you can have are deductible to this. Then there's ways to even simplify that, because you can use an employee leasing company, and then they handle all the payroll tax reporting as well. So you don't even have to deal with that headache to this. So you can make that efficiently do this all the way to what's called employee leasing in the United States, where they really aren't your employee. You're paying a service to handle all that. And then guess what? that leasing fee is an expense to you off the rental property. So not on an individual standpoint, but as far as the company is concerned, if you hire somebody outside, yes, the salary is a deduction off of it. But your own, if you were to take a salary out of your rental property, no, that's not a that's not a deductible expense.
Thank you. I think that's probably what he meant.
Yeah.
I appreciate the answer. Next question: can a 1031 exchange be cross-state?
Yes, that is it's a federal issue, not a state issue. So yes,
Yeah,
it's able to be done
and
across state.
we've actually done many loans for clients that are getting out of the higher tax states like California and New York.
Yeah.
And they're using those funds to purchase in say Arizona or Nevada or Texas or even Florida. So
Highly recommend Texas. Very low bureaucratic state. Very landlord friendly to this. And I know Robert, we'd worked on a seminar where they had some units that were so for there. So if you're looking at investments, Robert can even help you purchase a unit.
yes,
in Texas.
Next question is, how can foreign investors avoid withholding tax?
Generally, you can do what's called a W-8 Ben form to this, depending upon the location you are, and that will avoid withholding tax. We do the W-8 Ben on a regular basis. So your property manager may want to enforce that, but you come to us, and when we fill out the W-8 Ben for you, and that eliminates the tax withholding on this. But again, the tax withholding is based upon taxable profits. If there aren't any, there's no withholding. So you can be cash flow positive and not have to worry about withholding at all because you're tax negative on the property.
Okay, thank you. Next question. Is there a limit to the type of property that Investor Plus loan should purchase? As an example, could it only be single family? So a very good question. This one particular guy has asked actually quite a few questions. All of our loans in general, it's a 1 to 4 unit qualifies for the same. So if you're buying a single family or you're buying a quadplex, a 4 unit, it's going to qualify for the same loan programs. We have loan programs that can go over that amount. And, as Thomas had mentioned, we can actually even do loans for large apartment buildings, $30 million and up, that could qualify in a very similar fashion, just basically off of the cash flow. So to answer your question, pretty much any type of property, even from residential to commercial, can qualify for this. It just is going to vary maybe on the loan to value and then the rate and so forth. So next question. How long does the pre-approval letter good for? Very good question as well. Once we issue the pre-approval letter, it normally tends to be specific, or at least the realtor on the seller side will want it specific for that property. However, once we issue you that letter, as long as the loan program doesn't change or your financial situation doesn't change, we normally say it's good for 60 days. If your financial situation changes or there's a loan program adjustment or interest rate adjustment that could impact your pre-approval letter, we will certainly let you know. Next question. How does back end kick impact when sold, applied, in inheritance? Property will to your kids, as an example.
Okay. Good question. Okay. In the U.S. you have what's called step-up basis on inherited property. So if the kids inherit this property, it would go, their basis would be stepped up on the property to this. They would have to recapture the depreciation that goes back though to this, but the capital gains effectively goes away because the price goes up. The problem with that is, and this is one of the reasons to use the LLC and get away from the inheritance issue completely, is pass them the shares in the LLC rather than that, because you've got a tax on inherited property for non-resident aliens. That threshold is very, very low. So in order to get away with that, if you're looking at passing these assets to children, most of the time you're going to purchase them. It's better to do this inside an LLC, with it. So and it has to be a US based LLC owned by an individual. But that way you're able to get around, the entire inheritance issue, completely to this. And the LLC can do a like-kind exchange without any issues, to it.
And I guess another question on a similar basis, it says, hi, for the mortgage, can we use a domestic U.S. LLC versus property in our name? Yeah, absolutely. It's actually more and more common for people now to vest or own the property in an LLC rather than an individual name. And as Thomas went over earlier, there's a variety of reasons. So it's certainly something to look into. And if you have a requirement to put you or to get an LLC, we actually do have our American Mortgages concierge service that can actually assist you with setting up your LLC free of charge, of course. Whatever the LLC costs, you have to pay, but it's free of charge for the advice. Next question for you, Thomas. The infamous FERPTA tax. Maybe you can explain that and exactly what it is, and how maybe it can be mitigated, et cetera.
Effectively, it's the same situation to this. If you're using the regular tax code with this thing to this, and you're not selling to this, it just goes away. I mean, the reality of this is you try to keep this thing to be tax flow negative by refinancing and do this, and you just don't have the 30% withholding, issue to it. So it kicks you out of all this with the foreign ownership of this thing by setting this thing up in a particular way that just, you never hit that 30% tax because you never sell. But again, you can, and oddly selling the shares in the LLC does not kick in that tax, to it. One of the bigger advantages for owning it is that you can transfer those shares in the LLC and just have a capital gains issue instead of the 30% withholding, to it. So
Yeah,
it's a big advantage, with it.
No, but I think it comes down to using an expert, right? I mean, it's like for us, we always say, 100% of our clients are just like you. So, I mean, we understand exactly what this takes. It's very similar with you with the taxes. You're only working with foreign nationals and expats. So this is the stuff you understand and
Yeah, and the reality of international tax planning, it's a lot like shuffling the cards, but you have control of the cards you use and how you plan them. Proper planning allows you to stack the deck to minimize your taxation with it, and it's just how you do this. You again, you never really sell yourself out of rental property. You either pass it on to your heirs, and or you set this up in a way that you can move the LLC with this, and you can refinance. This is a weird investment in that leverage is always your friend, to it. It's counter to everything else. And I mean, for my personal house, I pay the mortgage off as soon as I possibly could. It's a matter of security for my, personal residence. But for rental property, mortgage, everything to this. Because you've got those tax advantage from a U.S. standpoint, just absolutely the way to go with this. Yeah.
Thank you, Thomas. Next question: do you have loans that can fund rehabs? We absolutely do. This is something we just launched probably about 6 months ago for foreign nationals, and it allows you to get a loan based on the ARV, so the after renovated value. It's a really good program that allows you to be able to purchase a property that maybe isn't in the best condition, but you will be able to buy it, rehab it, and then we'll take it out into a longer, proper mortgage after that. So another question: can my own time be deducted?
Unfortunately, no. No, that's the same question as the salary. No. Now, actually, how to describe this? It is, but you have to declare that then as income to yourself, and that's taxed at ordinary income rates, which you don't want to do with this. But the reality of it is, again, with depreciation and mortgage interest, you almost don't have to do that. 95% of these things will be tax flow negative for many years to this. And again, you can keep pushing that by refinancing. So, a lot of people, go through those questions. Can I deduct my own time and stuff? Only if you count that as an income to yourself, which you don't want to do. And effectively, how do I describe this? People are like, well, I'm my own property manager. And there are professional things you can do that give you some advantages if you manage this full time. But the reality of it is, as if you were to pay a property manager to run a 40-unit apartment complex, he then has to declare that income as a U.S. based salary. And if you are taking a salary or for yourself off and try to deduct your time, you then have to declare that at U.S. income at ordinary income rates, which completely gets rid of the purpose of having that as an expense anyway. So no, the practical thing is no.
Good answer. Okay, next question. Under a 1031 exchange, this would defer U.S. tax. However, would you not still need to pay tax in Canada, for example?
That you'd have to talk to a Canadian tax expert very specific onto it. Some countries have. I'm lucky that our home base is here in Thailand, and we do not have Thailand does not have a global tax system as a territorial tax system. Canada is one of those places where that could be a possibility, but you'd have to go through the specific rules in Canada to see where this does, and makes sense for you. But you'd have to talk to a Canadian expert on that one.
Okay, makes sense. Okay, next question. What are the costs to refinance at 8% 30-year mortgage after a few years? So I'm not sure I 100% understand what you're specifically asking, but all of our loan officers have a break-even analysis. So if you're looking to see if the cost makes sense after a certain period of time, we can calculate that out for you. So if you want to pull out cash, maybe take advantage of the strong dollar or the weak currency wherever you're at. We can figure out if it makes sense and at what point there'll be a break-even period. So I think you just have to contact one of our loan officers, and we can kind of help you with that. Okay, next question. If I want to have an LLC own the rental property, would the mortgage be in my name, or does it have to be through the LLC? Very good question. So in general, for the very vanilla mortgages, meaning you're buying a property in Texas, you're going to rent it out, there's nothing special about it, it's a standard investment. These are recourse loans, meaning that you would buy this as the guarantor, but that would be how we would get your loan approved. But the property itself, or the ownership of the property, can be held in that LLC. So basically, you qualify for the individual, but the property itself is held in the entity. Okay, next question. Does the $750,000 mortgage interest deduction apply for rental income properties?
No, that is based upon individual home ownership, not rental property. And this is the reason why people can own 48 units apartment complexes that can run into the tens of millions of dollars. That interest for rental property is outside of your regular regular individual tax return. It goes on your Schedule E as an item expense. And let me explain a little bit this. You as an individual can deduct off mortgage interest on your individual house if you're able to itemize your tax return. Okay. But you have to, in order to itemize, you have to exceed $12,500 of deductible expenses before you can itemize. If you're married, it's $25,000. That being said, mortgage interest on a rental property is deductible from $1 off of that income to it. So you have much better deductibility on interest for a rental property than you do for your own home mortgage. But the rule you're talking about, the $750,000 cap, is based upon an individual home mortgage for your residence, not a rental property.
So basically for your primary residential property.
Exactly. Your primary residence that you live at. Yeah, that's what that $750,000 cap is based on.
Okay, and we don't do those loans, so yeah, it wouldn't be relevant. Okay, next question. Would you incur transfer or capital gains tax for a foreign national parent changing title to a U.S. citizen adult child?
No. Okay, it's a gift to it, but it's a gift. You can end up with gift tax issues in this, and that one you're going to be some specific issues with this, because you do have limits. But you could potentially end up with the estate tax issue, depending upon valuation of this, because you have, I believe it's about $160,000 of estate tax you're allowed to use with this. But the cost basis on the unit, if it's gifted rather than inherited, stays the same as the parent. So let's say you gift a property that's worth $1 million to your child, that you cost you $100,000. So their cost basis when they go to sell it is still $100,000. If it's gifted as an inheritance issue to that child, the cost basis steps up to the $1 million upon the valuation of the date of your death, and so they have no capital gains with it. But if foreign nationals can have inheritance tax issues in this, which is part of the reason why people tend to do this as an LLC issue, with it, and you're transferring shares, which has a whole lot, which has a lot of, from a foreign national to a foreign national or U.S. national, which has a lot of big benefits to it. The LLC, if this is going to be held for a long term, the LLC is really a big significant way to deal with the inheritance tax issues on the property.
I think my suggestion on this would be to contact Thomas directly, because I'm assuming there's a lot of little.
That gets real complex very fast.
Yeah. So, but very good question. Okay, last question as we're coming up past the 1 hour mark, and we want to kind of keep it to 1 hour for everybody. Any additional questions we'll answer by emails. Everybody will get a video recording after this, even if you were not able to attend. And then you can also, see it on our websites or contact, each one of us individually.
They can contact us directly, and we can do a free half-hour consultation to this.
Yeah,
Just, normally it's $450 an hour, so it's $225 savings to just come, free. All you have to do is mention American Mortgages, and you get a free half-hour consultation by phone or Skype on this.
Fantastic. Thank you, Thomas. Okay, last question. Can you rent the property to your children and still take advantage of the tax treatment?
The rental income has to be declared at market rates, but yes, it's possible to do that. So you can't do $1 rental property. It has to be market rate rents are charged as income to this. So yes, it is possible to do that.
And going to that question, we just launched this loan program. It actually hasn't been set yet, but it'll probably be available by next week. And what it does is, if your child gets accepted to university in the U.S., it allows you to purchase a property using the cash flow method. So the American Mortgages Plus loan program to qualify for the property, meaning that you going to technically be renting the property to your child, as long as they have the proper visa. I think it's like an F1 visa. Then you'll be able to purchase the property as it would be as an investment property. So super fantastic program. Definitely, we've had a lot of requests for it, so we were able to kind of just launched, I think, by next week. So any questions that you have on that or any of the other programs that we have, feel free to reach out. Thomas, you have any parting words that
I was going to add to that, that's a new program we hadn't informed me to, but student-oriented housing around universities has been very, very profitable for clients of mine over the generations to it. That is always very high demand housing to this. And, you can put your child into that rental unit and then continue it on thereafter. And, a lot of times pay for the education just in the increase of the property value to it. It's a really nice way to grow your assets and effectively, have your child live someplace for free because of the investment gains in the property to it. Student-oriented housing has always been really, really, really profitable. We've had a lot of clients who've been very successful at that, with it.
Great. Okay. Well, Thomas, thank you very much for your time.
Thank you.
And everybody that has joined, we really appreciate it. Again, if you have any questions on tax savings or anything tax related to the U.S., whether you're an expat or a foreign national, Thomas is your guy. Again, he's being very generous for American Mortgages clients to give you a free 30-minute, questions and answer session or whatever it may be. But we really appreciate that, Thomas. Thank you.
Okay. Thank you.
And everybody, thank you again for your time. The next webinar will be held on June 16th with Dorvest. has a very unique way of investing in property. So we hope we see you then. Thank you, everybody, for your time. We appreciate it, and we look forward to seeing you again. Thomas, thank you as well.
Thank you.
And we will be talking soon.